Hello, great traders. Look at the chart on your screen. Assuming that you do not have anything like fundamental analysis, you do not have indicators, and you are presented with only a chart like what you have seen on the screen. What decision are you going to take right now to ensure that you make money out of this chart? That answer is found in the market structure strategy that we're about to share with you. We want to look at a way for you to understand the nature of the market at any point and be able to make valid trades that can increase your chances of making money out of the forex market in trading. My name is David Wekulom, currency trader at Well, and let's look at the agenda for today. We'll be looking at basic features of the market, how to identify a valid trend, how to establish a valid break of structure and change of character, how to identify trend reversal, entry and exit strategies using market structure and real life examples. If you are new to this channel, please, I want you to do me a favor. We just started the channel newly, and we want you to subscribe, hit the notification button. Once I get a sizable number of persons, I will start doing live analysis, and I will be dropping so many educational videos that are free for you to improve your trading. So let's look at the basic features of the market. The forex market always moves in three phases. Either it is in an uptrend, as you can see, with higher highs and higher lows, or it is in a range or consolidation, as it is called, when it is giving you highs and lows without a very organized fashion. And then you can see in a downtrend, it gives you lower highs and lower lows, lower highs and lower lows, and every point, this is what the forex market does. Now, market structure actually is how the market is positioned at every point in time, whether it's in an uptrend, a range, or a consolidation. So let's look at a trend. Anytime that the market wants to give a trend, it begins with an impulse move. So after the impulse move, there is a pullback. So once there is an impulse move and a pullback, you have enough information for you to decide the next rate that you're going to take. So you mark the beginning of that impulse move and the peak where the market gets to before the correction. So once you have marked the beginning of the impulse and the correction, you have established a range. So let me make this clear to you. Anytime in market structure, you need to understand that there is what is called internal structure and external structures. Whatever the market will do inside this range is internal structure. The external structure only comes when it breaks out of the range, either to the upside or to the downside. So let's watch what happened. The market actually does another impulse move leading to a break of structure because this high was taken off. So once there is a break of structure, you have established a range, and most of the time the market does not move in straight line as you see. It can move with a smaller trend in between. So let's see what happened. The market did a break of structure, went there to create another high and started doing a correction. So once that correction begins, you pick a new range now, and the top, the highest point where the market got to before that corrective move, and mark it as the new range. Whatever the market will do inside within this place is the internal structure. The external structure comes when it breaks to either side. So if the market breaks to the upside, no matter the complex corrections that it is done internally, this market is in an uptrend. So watch, the market has come down to something that looks like a downtrend, and some forex traders are confused. They begin to think that the market has changed direction and is going. Before you know it, the market made another move, another impulse move, leading to a break of structure which has taken off this high. And what you can be sure right now is that the market is in an uptrend, because it is now making this was a low, a high, a lower high, a higher high, and lower higher lows and lower highs and all that. The market is in an uptrend. So watch what happened after the break of structure. A new trading range is found. The market did another corrective move, and then you have established the range. Whatever the market does inside here is internal. Then the market came very close to this place. It could not break, and it is beginning to give you signs that the trend is about to change. And after that, watch what happened. The market did another movement to the downside and took away the lower part of that. And this actually is what is called a change of character. So anytime that the market is doing a pullback, it should not take the lower part of the range for an uptrend. But here it has clearly taken up. That is what is called a change of character. And the change of character is the first sign of a trend reversal. Let's look at another example. This is in a downtrend. The market started with an impulse move to the downside, then a correction. After the correction, you establish the range. This is the valid range. Whatever the market does inside this range is internal. But let's watch what happened. The market actually came and took the lower part of that range, leading to a break of structure, telling you that a downtrend is about to begin. And then after the break of structure, a new trading range is formed. You pick the beginning of that new impulse wave and the lowest point where it reached before it turned back, and then establish this as a new trading range. Let's watch what the market did. It came here, went down, came down, and traded complex, confused a lot of people who do not understand market structure. And after that, what happened next? The market was still playing playing around, and then it came and broke the lower side. And without confusion, some people will be thinking here that the market has changed the trend, but the trend is purely a downtrend. Okay, so after that break of structure, as it happened, the market established a new range, and then this new range, the market did another break of structure. So after the break of structure, a new trading range was established. For this time, the market came here, tried, and took away the higher part of that range, and this is what is called a change of character, which is the first sign of a trend reversal, telling you that the downtrend is over and now an uptrend is about to begin. So if you were looking for sell opportunities, it's time for you to watch what will happen in the market for you to take a buy instead. So let's analyze the break of structure and know what is valid and what is not valid. Anytime that the market is making an impulse move that can lead to a break of structure, what happens when the market is about to make a break of structure? It has to close. The body of the candle has to break that level and close above it. Even if it closed and the next candle came back, then it has established a break of structure, as you can see here clearly. Now, another way that there can be a valid break of structure, if the market comes to this place and break it with a wick, this first wick that break and it comes in and closes does not establish a break of structure. If the next bearish candle comes to that point and break it, and then watch the peak, the top of that wick, the wick goes beyond the previous wick of the previous candle's wick, you will know that these two are valid break of structure. Let's watch invalid break of structure. When the market comes, break that limit with a kind of wick. No, after the wick, the market closes inside, and the next candle that forms is a bullish candle. This is not a break of structure. This is just a liquidity grab. The market just went there to pick the orders that are available, and then you can see. Then another one that is not a valid break of structure, when the market comes to that point and then it breaks with a wick, then the next candle wick that forms did not reach did not go beyond the previous candle wick. These two are not valid break of structure, and this thing also applies to the buy examples. As you have seen here, the candle must close with a body, and here if it closes with a wick previously, the next candle wick must go beyond that point. And if it closes with a wick and the next candle wick did not get to that point, it is not valid. And here, if it closes with a wick and the next candle is bearish, you can be sure that this is not valid break of structure. Now let's look at the change of character. Anytime that the market makes an impulse move and a pullback, and you are seeing that the trend is continuing, the break or the change of character will happen when the market will come and take away that high, as you can see clearly here. In this other example, the market was in an uptrend, and then it took away this support level, and then it established a change of character. So those two are valid. But when you are looking at a valid change of character, you must look at the scale. Let's look at here. The market came here, made a pullback, another impulse move and a pullback. However, it came here, made an impulse move and a pullback, and a final impulse move that led to a break of structure. But watch this scale. This scale is very small compared to these other ones. If you take the measurement of this compared to what has happened previously, this is not even up to half of the movement. So this cannot be seen as a valid change of character because of the scale. Let's look at this other example. This other one, the market made the final impulse move, and then it came here, took out this level, and there was a break of structure. However, the next movement took out that high, leading to a valid change of character. Here you can look at the scale here. This is up to 100%. So that is that. And then let's look at defining a valid trend. 3 steps. If a trend has changed, what can you see in any movement, in any time frame at all, that you can beat your chest and say that the trend has changed? First, there need to be a change of character. As you have seen, this market was in a downtrend. Now it made a final impulse move leading to a break of structure, and after that the market made a very complex pullback correction that took away that high, which is called the change of character. The first sign of a trend reversal is the change of character. Next is a pullback. This market must go down to a demand zone in this example, and after that demand zone there is a final impulse move that led to the first break of structure after the change of character. So these are the first things. The first thing is that there must be a change of character. Then secondly, there will be a pullback, and a final point is that there must be the final impulse move that took away that high, leading to the first break of structure, and that has established a valid trend reversal. And this also applies to the bearish example. Now, what are the entry strategies? Let's watch this. The market did an impulse move and is beginning to do a corrective move. Now, what you need to watch is that between the beginning of that impulse move to the bottom of that impulse move, you should know that that is a range. However, there is an internal structure, and this internal structure sometimes is a mini trend. If you go to a lower time frame, let's assume that you are on 4-hour time frame. If you go to 15-minute time frame, you will see a complex pullback like this, and this is also a valid trend on the lower time frame. So what you will wait for, a break of structure as a change of character. You see that after the market was like in a mini uptrend within the range, and this mini uptrend was actually a corrective move in the higher time frame, but in the lower time frame it was a kind of uptrend. So after the uptrend, you wait for a break, a change of character. As it happens like this, the market took away this flow, and that tells you that it's time for you to enter the market. So what you will just do, you will wait for the first pullback to a kind of supply zone, and then you will enter the market. Let's watch what. So this is an internal change of character. You wait for a pullback, and once that pullback is there, you bring out your this in and place the trade. You can pick a demand zone, a supply zone there, enter the trade, and target a risk reward ratio of up to 1:4 to 1:5. So this is a valid way to enter, and then you can see after that the market enters. What you will need to understand is that when the market is moving in your favor, when it comes to this high maybe with a risk reward ratio of 1:3, you can close the position. All right, so let's watch what happened for a buy position where the market gave you a final impulse move, a bullish impulse move, and then you were waiting for a correction. And this correction, this is it's like a trend. It was giving you lower lows and lower highs in a lower time frame. It can also happen in the same time frame, but it's better for you to go to a lower time frame. You know what we do in a multi-time frame analysis. And after this, you wait for a change of character like what has happened here. And after that change of character, you check down here for a demand zone, and then you can take the trade there at that demand zone. Another way that you can use this is for you to use Fibonacci retracement. After the change of character, internal change of character, you can pick Fibonacci tool and measure from here to there. If you want to watch my video on Fibonacci, I've already done a video that explains the Fibonacci retracement strategy, and that is there for you to watch. However, once you pick the demand zone there, you place the trade there, aim for a risk reward ratio of at least 1:3 to 1:4 or even above, and then the first take profit target is this high. This is high here because the market, this is a correction, a next impulse move that happened on this just like this one. So once the market comes to that high with a risk reward ratio of 1:3, you can close some of your positions and leave the other positions to get to at least 1:5. So these are the entry strategies, and this was a breakdown of the market structure strategies. Okay, as you can see, this market went in your favor and gave you the profit you were looking for. Hello guys, this is a chart of New Zealand dollar against the Canadian dollar on the 4-hour time frame. We will use the 4-hour time frame to look at the major trend, then go to the 15 minutes time frame to see where we can execute our trade. So here now, let's do something. We will pick a horizontal ray and draw. Now the last break of structure that happened was around here. If you take this is the last break of structure that happened. Previously we had one here which has already played out. We had another one somewhere here. We had others there. But the last one we are interested in is after this break of structure. This was the low that led to that break of structure. So we can take our array and mark the top of that place, and this was the beginning of that move that led to the break of structure. So this is the range. This is our reference range. Whatever is happening here is our concern right now. Okay, so now let's look at this. Let me delete this out. Let me delete this. Okay, I've taken that out. We will go to the 15 minutes time frame and see if there is an entry opportunity for us. So let's take a trend line and mark this area. If we will see an internal change of character. Okay, look at this area. So we can go to the 15 minutes time frame now and observe what has happened. We are now in the 15 minutes time frame. Let's push this in out and arrange our chart in a way. So you can see the range. This from here to here is the 4-hour time frame. Now on the 15 minutes, see it clearly. This is an internal structure on the 15 minutes. So let's analyze it together. The market came here, tried this point, and went here. This after it touched that level, you can see that this was the beginning of that move on the 15 minutes time frame. Okay, so after the market broke the structure here, went up, came down, and was struggling around this range. Finally, there was a change of character here. Okay, internal change of character. So we can label this point as an internal change of character. Let's take a text and draw this one right here as internal internal change of character. Okay, so this was an internal change of character on 15 minutes time frame. Okay, so after the internal change of character, let's plot other things. See, there was a move, a pullback to this point. Now there was another, after this there was another move, another pullback, another move. Because after this move, you can see that there was a change of a break of structure here, and after the break of structure, this became our reference range. Okay, so let's check what happened to our reference range. If you take this rectangle and draw from the peak there to the bottom and extend this to the future, you will see what the market did. The market came here, did a pullback and was struggling. Finally, it broke this point at the top. It broke this point at the top, which is what we'll be looking for when we explained our entry and exit strategy for a buy. You see that there was a pullback trend, then there is now an external break of structure that can trigger our entry. So let's label this place as a change of character. Okay, so after the change of character, I think this rectangle has done its work. We can delete it. So what we are left with is the decision, because the market is bullish now. It has realigned to our 4-minute trend, 4-hour trend. So what can you do? You now watch, this place was a demand zone, and this was a nice place to take a long position somewhere here, and the stop loss there, and take profit. You take profit all the way to the 4-hour peak. Okay, another place that I am anticipating that this market can play out is this area. This area is important. Now let me get a confirmation with a Fibonacci retracement. If I take a Fibonacci retracement and draw from here to here, you can see that this place inside with the 0.78, which is 78.6% level. This is very important to us. So if we miss this first trade, this is another place for a buy. You can take the trade from here. Yes, it's a good place to enter the trade. I think this place is even better than the previous. Then if the 4-hour target, so you can see this market now will give us a risk reward ratio of about 6 to 1. Yes, if you can even get up to 7% risk reward ratio. This first one is a risk reward ratio of around 6. Okay, so this is already playing out. It triggered at our 50% fib level. If this plays out and there is no break to the upside, there is a pullback to this zone, this trade can also hold. This is an example of how you can use the market structure for day trading, right? Thank you. If you have any question, any live example that you want us, any currency you want us to analyze together, you can drop it on the comment and I will take it up.